This box is a fair value gap, and it might be the single most precise entry in all of trading. It's the footprint institutions leave when price moves too fast, a pocket of inefficiency the algorithm comes back to fill. Tag it correctly and your stop is only a few ticks wide. Miss it and you're chasing. In the next few minutes, a 3-stage blueprint, setup, confirmation, and execution to trade the gap like the algorithm that drew it. Stage 1, the setup. A fair value gap is a 3-candle imbalance. Look at the middle candle, a large one-sided move we call displacement. It's so aggressive that it leaves a range where only one side of the market actually traded. That void between the wick of the first candle and the wick of the third is the gap. It represents inefficiency, price delivered too quickly, and the algorithm treats it as unfinished business. A bullish gap sits below price and acts as support. A bearish gap sits above and acts as resistance. But the raw pattern alone is not the edge. Here's what separates a professional gap from noise. First, it must align with your higher time frame draw on liquidity, the direction price is actually reaching. Second, it must sit on the correct side of the dealing range. You buy fair value gaps in discount below the 50% equilibrium, and you sell them in premium above it. Buying a bullish gap that's already in premium is buying retail. And third, mark the consequent encroachment, the exact 50% midpoint of the gap. That CE is your precision line, the level the algorithm respects to the tick. The most common mistake, beginners box every gap on the chart and wonder why half of them fail. A gap is only meaningful if genuine displacement created it, a violent, decisive move, ideally one that broke structure. If the move that formed the gap was slow and overlapping, there's no institutional intent behind it, and nothing forcing price to return. No displacement, no trade. The strength of the move that creates the gap is the entire point. Stage 2, confirmation. Watch how the gap forms, an explosive displacement leg, and then critically, price begins to return to it. This is the part beginners fear and professionals wait for. You are not looking for price to reverse the entire move. You're looking for a retracement back into the inefficiency to rebalance it. As price trades back into the gap, you want a reaction, respect of the CE or the proximal edge, ideally a rejection wick showing the level held. That return and react is your confirmation the gap is live. Stack your confluences because each one raises the probability. Is the gap in discount for a long or premium for a short? Is price arriving during a kill zone, London or New York AM, when institutional volume enters? Does the setup agree with your daily bias and the higher time frame draw? One factor is a maybe. 3 or more aligning at the same gap is your A+ tier. When these line up, you're no longer guessing, you're trading in the direction the algorithm is already delivering price. Confirmation also means knowing when the gap has failed, and this is the inversion fair value gap. If price does not respect the gap, if it trades fully through and closes decisively beyond it, the level does not just disappear, it flips polarity. A bullish gap that fails becomes resistance. A bearish gap that fails becomes support. That's an inversion fair value gap. So a close through your gap is not just a stop out, it's information and often a signal in the opposite direction. Respect the invalidation and it becomes your next setup. Here's a pro tip to tighten your risk dramatically. As price enters the gap, drop to a lower time frame and wait for a small market structure shift inside the zone. A micro break of structure confirming buyers or sellers have stepped in. You convert a wide zone into a precise level and your stop shrinks accordingly. Same idea, a fraction of the risk and a far cleaner entry than blindly resting a limit in the middle of the gap. Stage 3, execution. Your entry is the consequent encroachment, the 50% of the gap for maximum precision or the proximal edge if you want a more conservative fill. The CE is where the algorithm most reliably reacts, so a limit order there gives you the tightest possible entry into the move. This is why the fair value gap is prized. It turns a general area of interest into a single exact price. You're not buying a zone and hoping. You're entering at the level institutional flow respects. Your stop goes just beyond the distal edge, the far side of the gap. If price fully fills and closes through the inefficiency, your idea is invalid. That's your line, not a random dollar amount. Your target is the draw on liquidity, the next pool of buy-side or sell-side liquidity price is reaching for an old high, an old low, a set of equal highs or lows. Because your stop hugs the gap and your target is the liquidity, precise fair value gap entries routinely deliver 3 to 1, 4 to 1, even 5 to 1 without forcing it. One more mistake that will cost you. Do not blindly rest a limit deep in a gap that sits right on a set of equal lows or an obvious swing low. That engineered liquidity gets swept first. Expect price to raid through the level, taking stops before it honors the gap. Often the cleanest version is the sweep and the gap together. Price runs the liquidity, then displaces back and offers the entry. And that sweep, that stop raid is the entire subject of the next video. Let's compress the blueprint. Set up a displacement-driven gap aligned with a higher time frame draw, sitting in discount for longs or premium for shorts. Confirmation, price returns to rebalance the gap, reacts at the CE, and stacks Confluence, kill zone, bias, dealing range. Execution, you enter at the CE, your stop rides just past the distal edge, and you target the liquidity price was always reaching for. Displacement leaves a gap, price returns to fill it, you enter at the 50% and you get paid to the liquidity. That's the fair value gap, from raw pattern to precise institutional entry. Now I want your answer in the comments, a specific one. Which time frame are your fair value gap entries most reliable on? The 15-minute, the 5-minute, or do you refine down to the 1-minute inside the zone? Tell me the pair and the session too. If this sharpened your entries, subscribe and watch the next one on the liquidity sweep that sets these gaps up. Educational only, not financial advice.